I'm in South Beach today, and I'm walking through a neighborhood that's very close to Lincoln Road. I don't think it really has a name, but there's lots of trees here, which is good because it's kind of a little bit raining outside. It's not like pouring, but it's drizzling, so trying to stay under cover as much as I can right now. One thing I have to address is I know a lot of you, especially buyers who are on the sidelines right now, who've been waiting for home prices to come down and waiting for the housing market to crash, are probably concerned after this banking crisis and wondering what's going to happen, because one thing that you probably saw is that interest rates came down practically overnight, and by a lot. They went down almost half a percentage point in just a few days, and that's not really common at all when you're talking about mortgage rates. And so the big question moving forward for a lot of home buyers is probably, well, what's going to happen now? And, are mortgage rates going to continue to go back down? Is the housing market crash going to be canceled? What's the deal with this? It's basically impossible to predict exactly what's going to happen, but I'm going to give you guys my take on this, on where I think things are going to go now that we're in this predicament. So the first thing is, at the beginning of the year, we did see an uptick in mortgage applications when they were hovering near the 6% range. And I do think that you're also going to see a spike in mortgage applications once rates come down even a little bit further, if they do come down further. And a lot of that's going to ride on the Fed meeting next week, which we'll talk about in a little while. The main thing that influences where the 30-year mortgage rates go is the yield on the 10-year Treasury. And the yields for the 10-year Treasury went down sharply recently because so many panicked investors decided to pull their money out of banks, to pull their money out of the stock market, and put it into these safe long-term treasuries out of fear that more banks might collapse and stock prices will go down even further, which is a big legitimate concern right now. Obviously, that's not really a big surprise that people are concerned about this. And that's why you're seeing the mortgage rates start to go down right now. But the question moving forward is, how low are the mortgage rates going to go because of this, and is it going to last? Now, personally, I don't think it's going to last, guys. Even if the Fed does a pause next week and they don't do any interest rate hikes, I think that the mortgage rates going down is going to be temporary, just like it was over the past couple of months when they were going down. I think once the initial panic is over when it comes to investors moving their money around and getting into these treasuries, then I think you're going to see rates stabilize and start to go back up, because what's likely going to happen is, even if the Fed pauses this month, the following meeting they're likely to resume raising their interest rates once again, because inflation is still a hot mess, like we talked about in yesterday's video, and that's still something that they need to get under control ASAP. To think that they're just going to pivot now and turn things around, it's very unlikely that that's going to happen. So the interest rates going down will be temporary. And will that temporarily increase affordability for some buyers? Yes, absolutely it will. Should you jump in and buy when this happens? Well, only you can decide that. But the thing is, I think it's very risky to do that, guys, because now that we've seen a couple of banks fail in just the last few days, and possibly a couple more in the big danger red zone of failing, this could really spell out disaster and really shows the larger, broader issues that are at stake right now, which are the markets are completely unstable. We don't know if more banks are going to fail in the coming weeks. And anybody who thought that there wasn't going to be a recession, you're kidding, guys. It's gonna happen. Like, if you don't already think this is a recession, these last couple days have been proof that the recession is knocking at our doorstep, if you don't think it's actually happening already. The problem is, if you decide to just jump in and say, okay, mortgage rates went down a little bit, I'm gonna buy, you're also taking the chance and putting at risk the fact that you're going to continue to have your job in this recession, because we've seen how many people have been getting laid off week after week, and let's face it, you don't know if you're going to be next. Now, I think if you're a business owner and you have multiple sources of income, or you have a lot of money saved and you can pay cash, for example. You know, even if your business were to decline substantially, you would still make more than enough money to pay for your house. Well, people like that, I think, are going to be fine and are not even going to be as affected as much by all of this anyways to begin with. But if you're somebody that works a regular 9-to-5 job and you don't know if you're going to be getting the axe soon, then you need to be very careful right now, because it can look very tempting when the interest rates come down and affordability increases for a little while to jump back into the market out of the fear of missing out, right? The FOMO. That will kick back in for a lot of people, unfortunately. So it's up to you whether or not you will resist that FOMO or not. You need to have in the back of your mind what's going to happen if there's a severe recession or even a depression at this point, guys. You need to be thinking about those sort of things. You have to be thinking long term right now and not just about, well, the mortgage payment is $150 less now. You know what I'm saying? Because that's very short-sighted. But we also know that when it comes to real estate or life in general, human behavior is very irrational. People do things that make 0 sense on paper. They do it out of emotions, right? These are emotional impulses when people decide to buy in times like this. That's why you'll probably see some people decide to take the bait. Okay, interest rates went down 0.5 point. I'm jumping back into the housing market before it's too late. If that's you and you're somebody who might be doing that, here's a couple things that I would just tell you to consider before making your final decision. First of all, if you're a couple, so you know, you're married or maybe you're not married, whatever, you're buying the house with a partner, okay? In the event, if one of you loses their job, can one person float all the monthly expenses, including your new house payment? Think about that for a minute. If the answer to that question is no, then there's no way you should be jumping in and buying right now, because the danger risk is just too high. Of course, you can do whatever you want. That's just my opinion. And the next thing to consider is I'd also be looking at what would happen if both of you just happen to lose your job at the same time. Do you have a big enough emergency fund saved up where you can pay all of your monthly expenses, including your new house payment now, for at least 3 or 4 months? Do you have that kind of money saved up after buying the house, guys? Because that's the thing. You're going to put a large down payment down to buy the house. It's not cheap to buy real estate, right? So are you going to have enough money left over after purchasing the house saved up in case of an emergency right now? Worst case scenario, both people loses their job, or say you're single and you're buying alone. Can you afford unemployment for a few months until you find something else? And if you answer no to both of these questions, you definitely should not be buying, even if mortgage rates do continue to go back down right now, because the overall economic risk factor is just too high at the moment, and there's way too many uncertainties going on right now. But of course, if you answered yes to both of those questions, then obviously you are in a much better financial position than most people, and your risk is minimal. And if you find a good deal in your area, and now you can get in at an even lower interest rate than you could, you know, say a couple months ago, well, then go ahead, seize the opportunity. You know, I'm all about seizing opportunities, but I'm also about weighing opportunity versus risk. And that's what we just discussed here. And I think a lot of people are not really in the position to take massive risk with their finances in such a vulnerable time. And that brings us right into, what is the Fed going to do, guys? Because that is going to have a massive impact on where things go. Now, the reality is nobody knows what the Fed is going to do at their meeting next week. There's all kinds of talk that maybe they're going to rate hike, you know, but it's going to be smaller than anticipated, or maybe they're just going to pause and keep the rates where they're at for now to make sure that more banks aren't going to fail or anything worse is going to happen. Now let's do a little run through of both scenarios right now to try and figure out what might happen with this next Fed meeting. Let's say they decide to continue with their interest rate hikes, You know, we don't care that the banks are failing, whatever. We're just going to keep moving forward because inflation is still a big problem, which it is. Okay, if they do that, then what might happen? Well, it's definitely going to trigger the possibility of more bank failures in the coming months, that's for sure. And it will likely be a fast track to the recession, guys. So on the one hand, I think that's good because it's going to weed out the bad actors right now. Silicon Valley Bank went under because of their poor investment strategies, and this whole thing is showing just how unstable this funny money system is that we have. And when you don't have a currency that's backed by anything, since we don't have the gold standard anymore, then people are allowed to take these massive risks and invest people's money in ways that they shouldn't be. So if they continue with their interest rate hikes, then it's likely just going to continue to break everything faster, which in my opinion is the way to go, only because the faster we break everything and the faster everything gets reset, then the quicker we're going to get out of this mess. Because it's also going to continue to make real estate more expensive, and it's going to deter even more people from getting out there and buying right now, which is ultimately what we need for home prices to come down as well. But let's say they go the other route and they pause interest rate hikes, no interest rate hike. Well, interest rates still aren't going down. It means that interest rates are still remaining where they are right now. And it also means that they're still highly likely to do more interest rate hikes at future meetings, but they're just kind of taking a wait and see approach to see, well, what's going to happen in the meantime. Let's make sure we stabilize things and there's not going to be more bank failures and this and that before we start with the rate hikes again. But in the meantime, inflation will be continuing to go up and get worse because they're not hiking rates fast enough. Even though it's the fastest they've ever hiked in history, it still has been too little too late. And the byproduct of that is going to be people's monthly budgets continuing to get squeezed tighter and tighter as inflation becomes a bigger and bigger problem. And once the recession finally does come, or it's official anyways, you're going to see more people that decided to FOMO into the market lose their homes because they didn't listen to what we talked about earlier. And you're also going to see, a lot of people get laid off and not be able to afford things at a time when life is more expensive than ever. And the worst part is if they do decide to pause on the interest rate hikes, right? And they decide to resume them later on, once this whole mess gets sorted out, but in the meantime, inflation is getting even further out of control, then when the recession does come and they actually get to the point where they want to pivot, where they actually want to start making rates go back down again, it's going to put them in an even worse situation, because they're going to be in a situation where they may need to lower interest rates at a time when inflation is still running out of control, which will ultimately probably push us into hyperinflation, guys. So that's not a good scenario either. So my thinking is there's really no right answer right now on what they do. It's kind of damned if you do and damned if you don't situation. And the Fed's in a very tricky spot because of this. And I think that they should still continue with their rate hikes, business as usual, and get inflation under control. Because if they don't, then everything else is going to tumble later on. Forget about the banks. Everything's going to be failing if we have inflation out of control. Businesses across the country will be failing. People will not be able to make payments. There will be massive defaults on everything because things are getting too expensive. And so you have to kind of treat the larger problem. At least that's my opinion on how I would handle it. And the larger problem is inflation, not a few banks failing. But of course, this is all just a guess and it's all my opinion, so feel free to share yours in the comments, and that way other people can get an idea of what everyone's thinking right now. And it's not just me who's saying these things, guys. You have, for example, billionaire Carl Icahn. He is a billionaire from New York and has recently relocated his business here to Florida, okay? And he told CNBC in an interview that right now the business climate is on a less than solid footing, and he said that the median household net worth right now is practically nothing, and that's not a good thing. And it's kind of a reflection of where things are right now. According to the most recent Federal Reserve data, the average American household net worth is $121,000 as of right now, which supposedly is up 18% from 2016. But 2016 was 7 years ago, guys. So, and a lot has changed since then. Most notably real estate prices. So I'd be willing to bet that a large majority of people that have seen an increase in their net worth are likely property owners, okay? Because real estate is one of those magical assets that can just make you rich when you see things like this happen. And that's what probably happened to many people. But now that all of this is starting to turn around and we have the recession here, we have banks failing, we have unemployment and layoffs starting to go up, we have businesses starting to shut down and perform layoffs because they're just not making enough money right now, well, that net worth is likely to reverse very soon. Obviously, $121,000 net worth for a billionaire is a drop in the bucket, but I'm sure for a lot of people would say, yeah, you know, I'm happy with that being my net worth, depending on how old you are. It just goes to show, guys, that that's the entire household net worth, okay, of American families. That's everyone put together, everyone's assets. You're talking how much money you have in the bank, your cars, the value of your home, the value of your stock accounts, your portfolio accounts, your retirement accounts, everything comprises your net worth. And when you look at it from that angle, then it is a pretty low number because, you know, most people need a lot more than that just to retire, for example. So to say that that's your entire net worth, well, you're not doing too good, I guess, from that perspective. So Carl does have a point, and that's why I've been making these type of videos for you guys, to give you heads up on these certain things. And when you know what to look out for, you know, it makes it easier to get ahead. It makes it easier to increase your net worth. Like, I don't just tell you guys these things and then turn around and do the opposite. Like, I do exactly what I'm telling you guys to do in the videos. Like, for example, I would love to buy another investment property right now. I have some money saved for that, but I'm not doing it, guys. I'm resisting the urge to do it because I know that better deals are likely to come. And regardless of whatever the Fed does next week, I still think that we are going to be on track for a housing crash because whatever they do, it's probably just going to delay the inevitable, okay? If they decide to slow it down, then it's just going to slow the housing market crash down. It's not going to happen as fast as it's been happening, right? If they decide to continue with the rate increases, then housing market crash full speed ahead as before. And like I was telling you guys earlier in this video, that if you work a regular job, you need to be concerned about jumping in and FOMOing into the market. Well, that applies especially to people who work at Facebook because they just announced that they're going to be laying off an additional 10,000 people, guys. I mean, imagine how many 10,000 people is. If you had 10,000 people standing on this street right now, probably go from here all the way to the end of the street. That's a lot of people losing their jobs. On top of Facebook announcing these layoffs, Mark Zuckerberg came out and said, we've determined that employees who come to the office get more done. They still are going to have remote work positions, but he's now encouraging employees to find more opportunities to work with one another in person. He goes on to say, our early analysis of performance data suggests that engineers who either joined Meta in person and then transferred to remote or remained in person performed better on average than people who joined remotely. And that's a quote from Mark Zuckerberg. And the ironic thing about this is Meta was one of the very first companies during the pandemic to allow its employees to start working remotely. They were letting all types of employees start to request to work remotely if they wanted to, and now they're starting to have a change of heart. They're looking at other big tech companies like Amazon and Google reversing their policies and saying, hey, maybe they know something that we don't, and we should probably start getting people back into the office right now. And that's exactly what they're trying to do. And a lot of people mentioned in the last video I did last week about remote workers who are losing a lot of money with real estate right now because they were getting called back into the office. They mentioned like, hey, if you don't have a contract in writing guaranteeing your remote work position, then you got diddly squat. And I agree, guys. If you are somebody that is looking at a remote position with any company right now, you better make sure that it's not just the boss telling you, yeah, it's okay, you can work remote for now. It needs to be part of your employment agreement that they're going to allow you to work remotely indefinitely. This is a remote position you're getting hired for, not, oh, you know, it's going to be remote for a few months until we decide to change our mind, then you got to come back into the office. But even if that happens, even if you do get it in writing, it's not like these guys can't just reverse their position and fire you anyways. Of course they could still do that, but at least it gives you a little bit more security and protection, knowing that you're not going to have to worry about getting chopped because you don't want to come back into the office. And this is happening to people, guys. In fact, I'm going to share one last quick story with you guys that was sent to me by a subscriber, Mark, who sent me many stories before. And this is what happened to somebody that he knows. He says that he knows somebody that bought a condo in Fort Lauderdale Beach, okay? They're from San Francisco, and they were given the opportunity to work remotely. They decided to come over to Florida and buy this condo, right? I'm just kind of summarizing the story that he gave me here. But basically what happened, it was a group of guys, okay, 4 guys. They came to Fort Lauderdale, bought this condo, and it was a 3-bedroom condo on the beach that cost them $849K. You know, they all have salaries of over $200,000 a year working for these Silicon Valley tech companies, so it's not like they couldn't afford it. You know, that's not very expensive when you're splitting it 4 ways and you make these big salaries, right? Well, now they're all getting called back into the office because they work for Google, okay? And Google is another company that's making their employees come back to the office at least a few days a week. They tried to challenge it and say no, or at least they wanted relocation expenses, whatever. It's not happening. Google said, nope, you just got to come back. It was never part of your employment agreement to be working remotely like this, like we just said. So you got to come back to the office. So as of February, these guys decided to list the condo for sale. Mark forgot to tell me the listing price of the condo, but they bought it for $850, right, during the pandemic. Well, now the highest offer that they've had so far since listing the place in February has been $659. So already these guys are taking a $200,000 haircut without even considering closing costs and all of the fees related to selling the property, real estate commissions, everything else. So these guys are well over 200 grand upside down on this pandemic condo. So while I realize this is a remote work story and the consequences of people relocating and jumping the gun, this applies to the people in the very beginning of the video who might be tempted to go out and buy during this time of volatility when the mortgage rates come down. So just remember stories like this when you're making that decision, guys. Consider everything we talked about today before you jump in and decide that you want to take advantage of the lower rates, okay? I'm not saying you shouldn't. I'm just saying be prepared for whatever might come next, okay? And especially be prepared financially so that way you can weather the storm. The last thing I want to see is people that watch my channel failing right now and losing their homes because they just didn't listen and they just jumped the gun. So I want everybody to be successful and get a good deal on their next home and be able to keep that home and not lose it to foreclosure. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.